Good morning, everyone. Welcome to the webinar. In this webinar, we will be covering tax planning, and there'll be two broad parts. Firstly, tax planning strategies that can be implemented before 30th of June 2018. And then we can look at tax planning strategies that can be utilised at the time of preparation of your tax return from July onwards. So we'll just look at the first slide. So now let's look at tax planning strategies that need to be put in place prior to the end of the year, 30 June 2018. Firstly, let's look at superannuation strategies. Now, this is always the single and best tax planning strategy. The maximum deductible superannuation that can be claimed in this tax year is $25,000, and that's including the employer's 9.5% superannuation guarantee. So you could consider topping up your super to the maximum concessional amount of $25,000 and claiming the top-up deduction in your personal tax return. Note the age-based limitations from age 65 to 75. And of course, the super rules can be very complex, so make sure you confirm with your financial advisor. So for 2018 year, the super top-up can be paid direct into your super fund. There's no need to involve your employer with salary sacrifice as in prior years. So this is a very positive change in the rules. And be aware that the super must be received by your super fund by 30th of June. So allow 4 or 5 days at least for the transaction to be processed. Now, the $25,000 maximum concessional contribution includes your employer's 9.5% super guarantee payments and any amounts that you may have already salary sacrificed. So check on how much has been paid into your super fund before topping up to the $25,000. And another strategy is the spouse super contributions tax offset, which is worth $540 tax offset. Again, new rules for 2018 allow a full claim of the offset where the spouse assessable income, note, not taxable income, assessable income is up to $37,000. Previously, this was just $10,800, which cut a lot of people out of the strategy. The $540 tax offset phases out for spouse income above $40,000. Now, the maximum rebate is $540 of tax, and that's on a contribution of $3,000 into your spouse's super fund, although the contribution can be more than $3,000. This is an excellent strategy for couples where the wife ceases working to have children, or a couple where one partner is out of the workforce for some time. Note that the spouse contribution will not be subject to the 15% super contributions tax or the super surcharge, and when withdrawn from the super fund as a lump sum, it will be tax-free. Another strategy is the government co-contribution. So this is where the government will grant you up to $500 gift into your super fund. This is applicable to taxpayers with total income. Note again, a different definition of income, not taxable income, to taxpayers with total income below $36,813, phasing out for incomes up to $51,813. The way this works is that you make a personal contribution of $1,000 or more into your superannuation fund, and then the government pays $500 into your super fund after lodging of your tax return. There are a few traps with this strategy, so check with your advisor, or you can go to the tax office website if unsure, www.ato.gov.au. These days, the tax office has a lot of valuable resources that can be searched very easily. Now we just look at the next slide. Interest deductions. Again, consider prepaying 1 year's interest on an investment property or other deductible investment loans. Interest prepaid up to 12 months in advance can be deductible in this year, the 2018 year. Note this strategy has to be arranged with your bank or other lender. You cannot just pay a lump sum against your loan account. You must formally arrange the prepayment with your lender. Now, capital gains and losses. Let's look at year-end tax planning for capital gains. If you have sold shares or property during the year, firstly, review your realised capital gains and losses for the year. Do you have an overall net taxable capital gain? If yes, review any unrealised capital losses that you may have. And note that capital losses can only be offset against capital gains, not against ordinary income. So you may want to realise the capital loss in the same year as the capital gain. The broad rule of thumb is always try to realise capital losses before or in the same year as capital gains, not in a following tax year. And of course, the 50% capital gain discount on the gain generally applies to assets and investments held for more than 12 months. So double check on the purchase date before selling. For example, shares. A share held for 11 months could be held for a further month before selling to access the 50% capital gains tax discount. And note also the relevant date for sale is the contract date. For example, for a property, an investment property, for example, the date of the contract of sale is a relevant date, not the date of settlement, which can be on average 8 weeks later. Now, if you do have a substantial net capital gain, you should consider the superannuation and prepayment strategy previously covered to offset the gain, particularly if they help you stay in a lower tax bracket. We often get asked, what is the rate of tax on capital gains? And in fact, it's your normal income tax rate. Your net capital gain is added on to your other net income and taxed at your marginal tax rate. Okay, now they're the year-end tax planning strategy. Now let's look at strategies and practices that can be implemented after the end of the year at the time of preparing your tax return. So tax preparation time, be organised with your documentation. Supporting documentation. Work-related deductions can only be claimed if you have supporting documentation. Keep your receipts, and if you have a tax agent preparing your tax return, provide them with a summary of your claims with explaining notes and/or questions. This will save the tax agent a lot of time and reduce the cost. Most tax agents work on a time basis, so being organised with your paperwork will reduce the cost. And a tip here, the tax office have indicated that for this year, 2018, they will be paying particular attention to car travel claims, home office, clothing, and laundry claims. So let's look specifically at car running claims for work. This is often the largest work-related claim, therefore the tax office always looks at these very closely. If you have substantial use of your car for work, you must complete a logbook once every 5 years and complete a new logbook if your work changes substantially over those 5 years. The logbook must cover 12 continuous weeks. Now here's a tip, you can choose the 12 weeks of the year that gives you the best result. For example, it might be that in your business, the busiest time of the year is the 12 weeks leading up to Christmas. That would be the 12 weeks you could use your logbook. And note that travel between your home and place of work is generally considered private travel and not part of work-related travel. In other words, you must be traveling for work, not to and from work. There is a concessional method for claiming car costs. Where your car use for work covers less than 5,000 kilometres over the year, you can choose to use the concessional method of 66 cents per kilometre. Now, you don't need a logbook for this method, but you should be able to show how you kept track of the kilometres, for example, diary notes. We always suggest to people that they keep a logbook, and then at the end of the year, we can compare the claim, the logbook versus the 5,000 kilometres method, and you're entitled to choose the method that gives you the best result. Rental properties. Again, a few new rules apply for 2018 years, a few new traps here. From July 2017, you are no longer able to claim travel expenses relating to a residential property investment. Previously, these travel costs to inspect the property were deductible, but not for this year, not for this 2018 year. And also, you cannot claim depreciation on second-hand furniture, fixtures and fittings acquired after 9 May 2017. That was the date of the 2017 federal budget. So, for example, no depreciation on these items for a residential investment property purchased after 9th of May 2017. Now let's look now at the tax office's increased data matching information. This is the information the tax office gathers on you by matching your tax file number. It gathers this information together and puts them into a pre-fill information, which you can access when doing your tax return. So each year, the tax office has been able to gather more and more data matching information on taxpayers. For this year, 2018 year, the tax office will be receiving new information on the disposal of shares and property, foreign source income, and ride sourcing income, for example, such as Uber. And the tax office have signalled that for 2018 year, they will be looking very closely at claims for home office, clothing, laundry, and car claims for work. So, keeping records. You must keep your records for 5 years. You are required to keep your records for 5 years from the date of lodging your tax return. And note the tax office substantiation rules when claiming work-related expenses. The expense must be necessarily incurred in earning your income and not be of a private or domestic nature. In other words, the expense must pass both of those tests. The tax office say you need to ask yourself the question when claiming work-related expenses. Would your employer confirm that the expenses were required to earn your income? You must have written evidence to prove claims if your total work-related expenses exceed $300. If you do exceed the $300 in your claim, the records must prove the total amount, not just the amount over $300. Just a note, the $300 limit does not apply to claims for car expenses, meal allowances, or travel allowances expenses. There are special written evidence rules for substantiating these types of expenses. There are a few concessions for minor expenses of $10 each or less, providing the total of these expenses over the whole year is not more than $200. Another minor concession is where you've been unable to obtain written evidence, for example, tolls, parking meters, parking fees, where a receipt cannot be obtained. The tax office have a very useful download app for claiming work expenses, and you can get this by going to searching for My Deductions ATO, My Deductions ATO, and download the app. And lastly, beware of scammers. Tax time is a very popular period for scammers to target individuals and businesses. Keep yourself one step ahead by being aware of these scams. Note, for example, that the tax office will never email you or phone you and ask for your bank details or tax file numbers. If you get a phone call or email asking for your tax file number or bank account numbers, you know it must be a scam. So that just about wraps it up for the tax planning webinar. Thanks for your attention. If anyone has any questions, they can forward them through to us and we'll be happy to answer them by email or phone. And thank you for your attention.